Do tech earnings trump tariffs? Hi, everyone. I'm Maggie Lake, and today I'm talking markets with Peter Boockvar, CIO of Bleakley Advisors and author of the Boock Report on Substack. Hey, Peter, it's great to see you again.
Maggie, afternoon. Great to see you.
So we once again see some record highs intraday for S&P and NASDAQ, although they did sort of move off that back and forth over the course of the afternoon. But what's your sense of what's happening here? Are investors actually feeling that positive about earnings, or is there something else driving this?
Well, it's definitely that, and it's also the AI tech trade has gotten a second wind. That's really what's been driving a bulk of this move. If you look at other parts of the market, like the small cap index, the mid cap index, the transportation index, which we know is an important group of stocks with respect to its touch to the economy, they've all had nice rallies, but they're remaining well off its highs. So, and also we need to sprinkle on a bit of froth now that has entered the market. I was looking at a company called Open Door today, and its stock was 50 cents a couple of days ago, or maybe a week ago, and got as high as $5 today, up 100%. I think the meme stock crowd got into that one. And then you also have some other areas of excessive moves here in a very condensed period of time. And, the party is on. Party can continue on for the rest of the summer, but investors should acknowledge that we've reached, it's past midnight with this party, and can keep on going at 2, 3 o'clock. But it's just something to focus on here, where the market is ignoring, obviously, tariffs and the sort of mediocre economy that I still define it as, which to me, quantifying that is about a 1%, 1.5% economy, which I think we're in right now. But it's wild times to have the market shrug off some good stuff, some challenging news and stuff. But again, the AI tech trade, I think, is the main source of the rally, and that's why we're setting ourselves up for pretty interesting earnings season over the next couple of weeks, in particular when a lot of these big cap tech names report.
Yeah, we know we've got that coming up, and it's sort of why I asked you whether it feels like really based on fundamentals and earnings, or whether there's something else going on. Hey, everybody joining on Substack Live and YouTube. Great to see you. As always, drop your questions. Hi, Michael Cow, Globetrotter. Are you actually back, like in the U.S.? He's been on a world tour. I think we've all been following along. As usual, drop your questions, any comments you have in the chat, and we'll get to as many as we can. So does it, when you're talking about that froth, does it just feel like gambling? Are people just kind of like bored and have some time and are just gambling on this stuff? Or does it feel sort of like that irrational exuberance, excessive, maybe we're getting too complacent? Because they're not exactly the same thing, are they?
No, it's different, and it sort of could be idiosyncratic. I mean, Open Door is clearly just a casino game. When you're believing that a company that flips homes in this environment is a great place to see your stock up 10x. That's just pure speculation. A lot of this rally has been more expanding the multiple rather than any notable change in earnings expectations for the full year. So far, the beat rate in earnings is about 75%, which is what it always is. I always kid around, and I guarantee going into earnings season that about 75% of companies will beat earnings expectations, because that's just the game that's played. So that is really baseline. It's anything above that or below that that will determine whether earnings season is good or not. But I think in the aggregate, when GDP growth is only 1%, in the U.S. and growth globally is somewhat muted, it's hard to generate robust earnings, because you can't separate earnings from underlying economic activity.
Yeah. You mentioned we have Alphabet and Tesla coming out this week. Just to start, will be the start of some big tech names. What are you going to be listening for?
Well, with Tesla, certainly the state of their auto business. The stock is obviously trading still at a pretty lofty multiple on hopes of Optimus, their the robot business, but also self-driving. But that's still far into the future. Right now, their earnings are driven by their auto business, and want to hear about the state of the consumer, particularly how they're responding to the end of a lot of the tax credits and incentives that was a big driver of their growth, whether it was a tax credit that incentivized a buyer to buy their car, or a lot of these carbon offset payments that has driven a large part or most of their profits over the last couple of years. And then with Google, want to hear about their fundamental business with respect to the competitive challenges they're now experiencing with ChatGPT and other LLM models, but also what they have to say about the ad business. Because at the end of the day, a lot of their business is generated by advertising. Well, what's the state of your customer, particularly small, medium-sized businesses in this economic environment, and what's their inclination to spend on advertising, or if they're looking to save money because of uncertainty about their business, is that pulling back on ad spending? So that's what I'm most focused on with that name.
Yeah. Emma's asking what Peter's, a lot of people commenting 2 Peters in a row. Can't go wrong with that. What Peter was on last. Peter Brandt. I had a great conversation with Peter Brandt, longtime technician, 50 years trading this market and still making a living, which is pretty extraordinary. So it's always fun to talk to him. And he had some really interesting thoughts. One thing Peter was talking about, I want to talk a little bit more about that ad and search for Alphabet. But one thing Peter was talking about, since we're talking about the overall market right now, is kind of looking at the S&P and the dollar, not looking at the S&P really in terms of like earnings or momentum, but as in lieu of purchasing power. And he's like, people, his sort of thesis was owning the S&P is kind of being short the dollar. You're moving assets out of the dollar into stocks as a sort of store of value, which I thought was so interesting because we're always talking about gold as a store of value, debating whether Bitcoin is a store of value. But he was talking about this. And again, this is over the long term, folks, not short term if you're trading or even medium term, but over the long term, the S&P holds up pretty well as a store of value. Does that make sense to you, Peter? Do you think about it in terms of that?
Yeah, but anything we buy can be considered that. Anything that's priced in dollars. I mean, your house is priced in dollars, and that can be sort of a hedge against the devaluation of the dollar, and your value of your home goes up. Or a painting, or an antique car, or baseball cards. I mean, they're all sort of a store of value you can consider. Because over time, the dollar is the last 100 years, the dollar's lost 97% of its value. So anything that you own that's sort of a hard asset would be protection against that debasement. But that's sort of always the case. But that also means that also dependent on whether the stock you buy, the company you buy shares in, has pricing power.
Right.
Because if a company you buy stock in doesn't have pricing power, then that's no hedge against debasement of the dollar. We've seen plenty of companies that underperform. That's no hedge. You have to still buy, at the end of the day, a good company that generates free cash flow and that can grow its market share over time, that has a new product, an exciting new market that they're in. So you still have to be careful about the things that you buy. You're still buying a business, and businesses prosper and businesses fail. You got to focus on those that prosper, because those businesses that fail, you're going to lose your money, and that's no hedge against dollar devaluation.
Yeah, absolutely. So choose wisely. And by the way, this is why you do the fundamental work behind understanding what you want to own, and listen to all the conference calls and have that level of detail, because it does matter. So a couple questions coming in. Boris saying, great to see Peter. What could stop this risk on rally?
2 things that I am most focused on that could, and at some point we'll see if it does, is the rise in long-term interest rates, not just in the U.S. but around the world. We're seeing higher interest rates in Japan and Germany and France and the UK, the U.S. That is something that could. The 10-year back above 4.5%, a 10-year that goes to 4.75 or 5, which I think it will. I don't know when, but I do think it will. That is what could disrupt this. And also, as people digest this earnings season and the guidance, I think there's just this amazing complacency with the impact of tariffs, and which just amazes me, because I just don't think, as simple as it is to do the math, it just doesn't seem like enough people are doing the math around the level of where the dollar amount of these tariffs. If tariffs end up settling out at, call it a 15% baseline, we know it's 10, which is going to be the lowest, and this is on top of the 2.5 that we had going in. But just let's look at the 10 on $3.3 trillion of imported goods. That's a $330 billion tax. If it's 15%, you're talking about a $500 billion tax. Now, I know in 2017, the market went straight up because we loved the possibility of a cut in the corporate income tax rate from 35 to 21%. If we have a 15% baseline tariff on top of the 2.5, well, that's a tax of $500 billion. You're essentially taking away the entire cut and then some in the cut in the Trump tax cut back in 2017. You're essentially actually doubling the corporate income tax rate, because right now, estimated by the CBO, corporate income tax receipts are expected to be about $525 billion. So you layer on a $500 billion of taxes on top of that, you've doubled the corporate income tax. Now, will exporters to us eat some of that? Yeah, maybe. I'm sure they will some. But with the weakness in the dollar, that burden is back on the U.S. importer. So it's going to be mostly businesses and households that eat that. And I don't know if people are really understanding that concept. To what extent the consumer will eat it or corporate profit margins will, somebody will. And that's a drag on the economy. I mean, call me old school, but I love free markets and low taxes. Therefore, I'm not a fan of higher taxes. I understand that, the argument about lowering tariffs around the world, and well, we're not really doing that by this. It's proving out to be, and trying to lower non-trade barriers, tariff barriers. But I don't think layering on tariffs is a cure and the answer to and trying to accomplish lowering overall trade barriers. You're actually adding more to it. So I don't know. I think that it helps to explain why GDP growth in the first half of 2025 is about 1%. There used to be a time when 1% was knocking on the door of a recession. Now people call 1% growth resilient and are pricing in a 24 times S&P multiple on 1% growth. I hope 1% goes to 2 to 3 rather than 1% going to 0 to minus. But I think a lot will depend on how we absorb these tariffs.
Yeah. I think some people, we obviously know in April there was a lot of concern and kind of shock around the tariffs. And I think that some thought we'd start to see the impact, even though they've been on again, off again. We still know that even that base is higher. And I think that people thought we'd either start to see the impact or at least warnings, like really stern warnings coming from executives, from business owners, from the folks who've got to be trying to game out what this is going to result in. Is it just that they're delayed because Trump keeps moving the goalposts, or is there an argument that maybe this might not be the hit to the economy people think it is, or that it's so diluted across many parts of the supply chain that it's going to be something that we can absorb?
Well, the first half of 2024, GDP growth annualized to 2.3%. The first half of 2025, we're annualizing at 1%. So that is a cut in half in the growth rate of the U.S. economy. So we have seen an impact. With respect to inflation on the consumer side, well, in the June CPI report, tariffs on goods were all over that report. I mean, we saw 12-month inflation numbers in 1 month. And I say 1 month meaning from May to June. So in just May from June, we saw what has typically been annualized inflation growth rates in anything related to the house: appliances, window coverings, floor coverings, clocks, lamps. Toy prices were up 1.8% in June from May. Sporting goods prices were up more than 1% from May to June. The price of tires was up 0.9 from May to June. Apparel was up 0.4 from May to June. Everything that's covered by tariffs. So we got tariff goods price inflation. The question is, now we've obviously had an offset on the services side, which I think services prices will further decelerate in the back half of this year as we continue to roll through lower rental increases. So goods prices have clearly bottomed, and we saw that in core goods prices within PPI, which have been rising 2 to 0.3 every month this year for the last 6 months. So core goods prices have definitely bottomed and they're now beginning to rise, but that's being offset by slower services inflation. In the aggregate, yeah, we're still going to be around these CPI levels because goods prices are about 40% of overall CPI. but extend this out to next year. We're sowing the seeds for a re-acceleration in services inflation because rental growth is going to start picking up steam again in the back half of next year as the current excessive supply gets absorbed. And we are now building much less new multifamily apartments. So my point is that any deceleration in overall inflation is going to be temporary, and that inflation volatility, I believe, is something that is going to be around for the next couple of years. And while interest rates, while they may fall on the short end as the Fed cuts interest rates, long-term interest rates are going to stay high and are going to stay high globally, as I said earlier.
So speaking of volatility, Doug asked, is it time to hedge, VIX, question mark.
Hedge what?
Hedge, and then he said VIX, question mark.
VIX.
I'm assuming, yeah.
It's getting the timing right. I'm never smart enough to know. Just as we tell our children when they go out, when they're younger, be careful of their surroundings. As investors, we always have to be careful of our investing surroundings. And, as I said earlier, we've reached a moment of froth in the stock market. And just look at the daily chart in Open Door, as I said earlier, or the Buzz ETF, BUZZ, that has entered a parabolic move. We know how this parabolic move can take it even higher. I'm not picking that top, but we know what happens when something enters a parabolic phase. You get into the froth part. If you look at the City Panic Euphoria Index, it's now getting further into the euphoria area. But when does that matter tomorrow, or does that matter in 6 months? I have no idea. So I can't answer that question in terms of the timing of it. I was positive on the possibility that markets would broaden out. International markets have done very well, and not to be a bear on the market, but just to say there are other parts of the market that are now working. What I am confident on is that the Mag 7 trade is over in terms of its homogeneous, dominant contribution to the market. That group has splintered. You still have the winners of Meta, Microsoft, NVIDIA, but now you have the losers of Apple, Google, and Tesla, with Amazon sort of. We'll see how they report earnings and where that plays out. But as a group, it's splintered up, and so I think there is a changing complexion of the market. But just as I think that small mid cap stocks are going to finally carry some weight here. And while they have had a nice rally off the lows, they're still below where they were in November, December of last year. So while we've had this incredible run in markets, not all stocks are up this year, and not all stocks are up from where they were in the latter part of last year.
Yeah. Fantastic point. Roger I'm going to share this comment, just made a really interesting one. U.S. consumers pay for the interest payments either way, tax rates or tariffs. So I say make it all tariffs. Is it like the burden maybe goes more on the corporations if it's tariffs, if they can't pass along the price, as opposed to the government having to increase taxes on citizens because they need to somehow raise money?
Yes, but companies don't pay corporate taxes. They pass it on to the rest of us.
If they can. You're assuming they will. They have to.
Yeah, companies have every which way to pass on their higher cost to us. And okay, here's a perfect example where someone would not think that they're getting a higher price. Let's pretend you go into a dealer to buy a car, and pre-tariff, the MSRP was 50 grand. Post-tariff, the MSRP is still 50 grand. And you're thinking, okay, well, maybe they're not passing that price on to me. Maybe they're eating it, but they're not, because the interest rate they're going to charge you on financing the loan on that car is going to be 7.5% instead of 7 or 7.25. So you may think, okay, the MSRP hasn't changed, but you just paid 25 to 50 basis points more for that car, or that warranty cost, it's going to be a little more, or the price of whatever add-ons they put, it's going to cost a little bit more. So companies don't pay corporate income taxes. We do, because they find every which way to pass it on to us.
Yeah, that's a great example. But this is, thank you for that point, Roger, though, because I think people do see it that way, that somehow maybe it's a kind of rebalance that's needed. Emma was asking about your expectations for the dollar versus the euro, which is interesting because we're on this cusp where it looks like the Europeans are sort of getting ready to really go to battle with Trump over these tariffs. Do you think that's going to happen, and this is going to get ugly with the Europeans, that they're going to stand firm, or do we get a resolution? And how do you see euro dollar playing out against that?
Well, broadly speaking, for the dollar, we know it had its worst first half of the year since 1973. So it was weak across the board. Now, specifically, its cross rate with the euro, I do find it very interesting that the euro strength also has coincided with strength in European stock markets. The German DAX is having a great year in euro terms, about 17% or 18%. You can double that if it's in dollar terms. And I do believe the tariff war that we started lit a fire under a lot of different economic regions. It lit a fire under Canada to realize, we can't keep relying on selling our oil and natural gas to the U.S. We need to start greenlighting LNG terminals in British Columbia so we can start shipping stuff to Asia. We lit a fire under Europe to realize that they can't rely on us. They've realized that they've suffered. They put their economy through a suffering of red tape and bureaucracy and nonsense out of Brussels. And I think there's pushback against a lot of the blockages to economic growth there. We've obviously seen greater spending in Germany on the fiscal side in terms of building out infrastructure and so on, even though I'm not a fan of Keynesian spending. But they're still spending dollars, or I should say euros. And also the defense buildup that's going to take place there is going to be economically positive. So I wouldn't be surprised if the euro continued to rally here. Now, for perspective, going back to 1999 when the euro was first introduced, $1.17, the euro started at basically par. So it's not like the euro is that expensive. So I do think that there's a lot of potential for weakness. And also, I need to tie the dollar action to, yes, number one, foreign selling of the U.S. dollar because of disgust over the tariffs, but also foreigners piled into U.S. stocks over the last bunch of years. And, that created its own bid for the dollar as they bought Mag 7. Well, if the Mag 7 trade starts to shift and break up, then either foreigners are going to have to find other U.S. stocks to buy, or they're going to wake up and say, you know what? We don't necessarily need to buy only U.S. stocks with that incremental euro. Maybe we'll buy stocks within our own continent. Maybe we'll buy stocks in Asia, which is less bid for the dollar. So I think the dollar over the next couple of years, we've reached a major inflection point, and the dollar is going to weaken. Now, can it rally in the short term, which it's trying to stabilize because it's oversold here for sure. But I think this tariff war was the catalyst for a multi-year period of dollar weakness against a variety of currencies, not just against the euro.
Yeah, there was a great headline out today. I think it was on Bloomberg. German companies, 60 companies, creating some sort of investment fund of, I think, 100 billion euros rather to deploy. So there are some changes afoot. Do you see this rotation? Are you positive on European equities?
So yes, I remain so. Again, they've had a nice run here, so it's not like there's the same low-hanging fruit. But we own a bunch of stocks that are domiciled in Europe that, to me, are still very cheap. So, and if you get that currency kicker of a stronger euro, in addition, that helps that return as well. So yeah, I think Europe's attractive. We're finding individual names like Nestle and like boring stuff. Veolia Environment, BP and Shell in the UK, Tesco, largest supermarket company in the UK. So there are ways of playing Europe with boring businesses, stocks that are still cheap. I mean, take Asia, for example, the Hang Seng. And I know some people, they'll never invest in China or in Hong Kong. But, that market has outperformed the S&P 500 since December 2023. And it still only trades at like 12 times earnings. So there are plenty of cheap stuff around the world, even with the rally that we've seen over the past year and even year and a half. If you go back to, as I mentioned, in Hong Kong.
Yeah, Emma, I think that answers your question. Some of the Asian areas that Peter's looking at. Certainly, Hang Seng, one of them. Peter, I know you keep an eye on Japan as well. We had an election there. It was sort of, the results created a situation where people, it maybe wasn't the market mover that everyone thought it was going to be. I mean, the markets closed there, but what do you see? Is that do you like Japan? I've heard mixed things. We know Buffett went big and people were keen on it for a while, but I've been hearing sort of some people yes, some people no. How do you feel about Japan?
So we're long Japan. We've been long Japan for a bunch of years now, thinking that it's still a very attractive market. With China, Japan itself as an economy obviously faces its own challenges with its shrinking population, but a lot of phenomenal Japanese companies are benefiting from global growth, particularly in the Asian region where half the world lives. So we remain bullish. Now with the election, Ashiba is essentially a lame duck. And while he may stay in power for a period of time, not having a majority in both the lower and upper house makes his situation very tenuous. Question, though, is what replaces him, and it's sort of unclear. Some of the campaigning has been on lifting fiscal stimulus, particularly cutting the consumption tax, which I'm all for, to try to stimulate consumer spending, because the consumer, and here was the bottom line in the election. We were reminded once again that your population does not like higher inflation. This was a revolt election on the higher cost of living in Japan. We've had decades of the Bank of Japan doing everything they could to generate higher inflation. And now that they did finally generate higher inflation, the people are pissed off about it. Meanwhile, the BOJ still has an overnight rate at 50 basis points. Now, with respect to, now, if whatever comes of this, and let's just say a Shiba steps down and there's a new coalition, if they do go down that fiscal road, then long-term interest rates in Japan are going to go even higher, which will then have a ripple effect throughout the world. So I'm watching it closely. I watch Japan closely. I watch JGBs closely. I watch the yen closely. The reaction to the election is still somewhat muddled until we know whether Ashiba is staying or not, or what the coalition looks like. So I don't know in the short term necessarily how to react to it, but we still find Japanese stocks attractive.
It's an interesting situation. Do you feel like Japan, the Japanese authorities, it seems like they're moving into a different phase? Can they manage that orderly? Like, we've had to ask the question before, are they losing control of the bond market? We've seen the yen have some pretty spectacular moves. They're coming out of this extraordinary period of negative rates and really trying to cap that. When you shift into something else, it's sometimes very hard to do it in an orderly manner. Do you think that they can do that?
Yeah, this is an interesting moment. I mean, let's put ourselves in Governor Ueda's shoes of the BOJ. And because of you, Ashiba may have to resign because of this inflation story. I mean, inflation's been running, core being ex-food and fuel, continuously is running north of 3%. And you have Ueda having the gall to say that according to their underlying inflation estimates, it's still running below 2. So they have this nonsensical internal framework that has resulted in an overnight rate that's still only 50 basis points. So if I'm a Japanese LDP leader who is supportive of Ashiba, I would be all over Ueda and say, thank you, Ueda. You just cost my guy this election, because what are you looking at and thinking that inflation is still too low, that you need to run policy like this? My point is that we are heading to a major butting of heads between the Japanese government, the Japanese people, and the BOJ. And it'll be really interesting to see how this gets reconciled, because if this forces the BOJ to get a bit more aggressive in tightening policy, it's going to have ripple effects throughout global bond markets.
Yeah. What is their motivation for not? If inflation is running hot, what's their motivation for continuing to hang on?
They have this internal econometric model measuring what they think is what's called underlying inflation. Now, what goes into that, I'm not exactly clear, but their underlying inflation number is less than 2. That's what their rationale is. And this whole idea of let's run inflation hot and then get wages to rise. Well, inflation running hotter than wages you're no better off. And if wages even grew within line of inflation, you're still no better off. So this entire experiment of wanting higher inflation has been a complete failure, and it should be a lesson to everyone and any supporter of a central bank that tells you that they need to generate higher inflation as somehow being a good thing.
Yeah. So let's finish up with the Fed. Speaking of pressure, do we think Powell is going to hang on to his job, and will the market be disrupted and react poorly if for some reason he's forced out?
I think he's absolutely going to hang on to his job. I think everyone knows how much of a mess it would be if he was not. Even Trump, I think, understands that, or at least he was told that. So I don't think he's going anywhere. And I think he is going to remain steadfast in doing what he thinks he should be doing. But even the next Fed chair, whether it's Warsh or Kevin Hassett or Chris Waller, that is a poisoned seat as long as you are chair under Trump. I am a big fan of Kevin Warsh, but that's not a situation you want to be in with him as president, because every decision you make is going to be questioned. And I don't think that that's a situation one wants to be in as Fed chair. Now, granted, of course, there are other voters, and there'll be plenty of other opinions on that committee. But that's a hot seat that I think is treacherous for anyone, as long as you have this pressure. Now, Trump is not the first president to pressure a Fed chair. We've seen this movie many times.
I think he's gone further than most, though, right? With his investigation into the renovation.
Yeah, as opposed to the previous instances where it was behind closed doors.
Yeah, and they just complained. They didn't seem like they were gunning in the same way. I mean, you could argue this looks a lot like they're pretty serious about it. I mean, it's a lot of noise if they're not.
Yeah, and there's also this they didn't learn the lesson of September 2024 when the Fed cut and long rates went straight up. They're talking very simplistically. We need mortgage rates down. So the Fed needs to cut. Well, mortgage rates may actually go up if the Fed cuts. Now, Trump was honest with what he wants. He wants lower financing costs.
Yeah. A lot at play this August, Peter. So great to catch up with you. Thank you so much. I always love hearing what you have to say. And as I said, you do so much homework on the details that it's always a pleasure.
Thanks, Maggie. Appreciate it.
What's your earning? What's the earning you're most looking forward to hearing from? What's the big one for you?
That's a great question. I want to hear from companies that are importing stuff from overseas and how they're managing the tariff situation. 3M reported on Friday. On the surface, it looked like a good quarter. Stocks had an incredible run, but the stock got hit after numbers. They said full year earnings were going to get hit by 50 cents per share after mitigating the impact of tariffs. And then I want to hear what big cap tech says about both their business and their CapEx spend, because they've been driving the stock market train. Particularly NVIDIA, Microsoft, and Meta, even though NVIDIA is not going to be reporting for a bit now. But what Microsoft and Meta say, because they've been, big drivers of this equity bust. I mean, keep in mind, Microsoft stock up until, a month ago was still trading below where it was in July 2024. So is this, a head fake rally, or is this substantiated by numbers? And that'll be interesting to see.
Yeah, for sure. It's going to be fascinating, especially given the moves we've just seen. If you are not following Peter and his work on Substack, you should be, because he's so detailed and listens to all of these conference calls, and it's a must, especially during earnings season when we're all really busy. Always pulls out the bits that we should all be paying attention to. So we'll drop all his info in the description as usual. Peter, thanks so much. Take good care. We'll see you again soon. All right, and thanks to all of you. Just a heads up. Speaking of tariffs, had a fantastic conversation with Powell Macro. Really, really interesting. Cloud Bear, you may know him by, on Substack and Twitter. And so it was really fun. We really covered a lot of ground, talked a lot about tariffs and a lot about some of the risks he sees out there. So looking forward to that. We'll release that one on Friday. So keep an eye out for that. Thanks, everybody. We'll see you all again Wednesday. Darius Dale's with us, so join us for that. In the meantime, as always, take care and good luck out there.